Coolabah is one of the most active public credit traders in the world, and we are certainly trading more Aussie public credit than any other manager globally. We have $15 billion of net assets under management, and we have a really big team, particularly for a public credit manager. We have 53 full-time executives. That consists of 11 traders and portfolio managers, and also 21 analysts. 21 analysts consists of a 12-strong data science team. We're extremely quantitative in the way we approach our investment. Our data science team is not just a bunch of statisticians, they're also software engineers, implementing, developing, improving, and running our models, which we use. And around, or at least 98 of our investment decisions, 98 of our trades that we do in our portfolios are driven by those proprietary quantitative models. We currently trade around about $500 million of bonds a day, and since the beginning of 2025, we've traded around 64 billion of bonds. So how are we different to traditional fixed income managers, and how are we delivering consistent alpha through the cycle and in different market conditions? Well, traditional managers typically pull on these three levers. The first one is taking bets on interest rate duration, overweight treasury yields, underweight treasury yields. We think it's really difficult to get a durable edge from taking macro bets on interest rates, so we don't do it. We hedge all of our portfolios either to zero duration, or we implement the benchmarks duration. Second of all, many traditional credit managers, they take more default risk by going down the credit spectrum into sub-investment grade bonds. Even an investment grade portfolio at many traditional managers will contain some sub-investment grade bonds. For example, double B rated, single B rated, triple C, in order to generate higher yield, in order to generate yield pickup. They're taking more default risk. We don't do that. We're focused on investing and trading in the highest quality segments of investment grade credit globally, and I'll explain a little bit more about that in a second. A third lever that a traditional fixed income manager will pull on is illiquidity risk premium. They would argue you get paid more for taking illiquidity risk, investing in private placements, ABS, securitized transactions. That may be the case, but we don't do any of that. We like to keep our portfolio extremely liquid and flexible to be able to take advantage of market dislocations. What we're focused on is buying a bond that yields 6.1%, for example, when our models tell us its fair value yield is only 6%, and looking to monetize the capital gain that comes from the reduction in that yield from 6.1 to 6. That's what we're focused on. I mentioned a moment ago that we are focused on the highest quality part of the investment grade credit spectrum across the globe. So if you look at that universe, there are around about 7,000 issuers. What we do, our credit research team are whittling that down very rapidly into a focus universe of 305 issuers. That's our investable universe. You may say, well, 305 out of 7,000, that's not that many. Well, it actually represents 55% of the global market cap of IG credit. So it's massive. It's the lion's share of the market. It's also, in our view, the highest quality part of the market, and also largely the most liquid. We're focused on allocating to globally systemically important institutions, implicitly government guaranteed issuers, monopolists, oligopolists, blue chip companies. We're not interested in small issuers around the edges. We're not interested in taking cuspy, uncertain credit risk. We're trying to eliminate credit uncertainty from our portfolios, unlike traditional managers. And that's helping us deliver durable excess returns or alpha through the cycle, through periods of positive risk environments and negative risk environments. I want to take you through some data. We're pretty obsessed with data as a firm. This is a chart which shows all of our new issue trading, the equivalent of IPOs in bonds, since the end of 2020. Each dot represents a cell of a bond. This chart represents around about 55 billion of trades in total across global credit. The red dots are Aussie dollar denominated bonds, green dots sterling, purple dots US dollars. The height of the dot represents the profit after hedging interest rate duration that I mentioned earlier. And the x-axis represents the date on which we sold that bond. And what you can see here is pretty durable positive excess returns over this time period. We've been able to generate an IRR of 34% in this new issues trading. You may say, well, there's coupon income. Well, if we deduct that 4.1% of coupon income, that leaves us with a 30% capital gain IRR over this period. What's really interesting is our holding period on this new issues trading is only 2 days. So we're able to monetize those gains in yield, like the example I gave, 6.1 yield to 6 yield, in a median period of just 2 days. And we have a hit rate, a success rate of 91.5% in our new issues trading. So you may say, well, those are fantastic IRRs. Why don't you just invest 100% of the portfolio in new issues? Well, if we could, we would. But in practice, we need to supplement it with secondary market positions. So what does our secondary market trading look like? Well, this is the same chart, but for bonds that already exist, where we buy a bond that already exists, and then we sell it, ideally for a profit. If our models tell us a bond is cheap to our model's fair value, that's a candidate for buying that bond looking to monetize a capital gain through compression of the yield. Here you can see we've generated an IRR of 7.3% since the end of 2020. Deducting coupon interest of 2.7, that's 4.5% capital gain IRR. And the median holding period, and there's a big difference here between secondary and new issue trading, the median holding period for secondary trading is 50 days, so much longer. Our success rate in secondary trading is 86.6%. You may ask, well, how does this vary depending on the environment? I want to show you exactly how it varies. The color of the dots represents the type of credit environment. So, for example, the red dots represent an environment where credit spreads are tightening, an environment where risk is rallying, it's constructive for risk premia in general. The green dots represent a period where credit spreads are moving sideways, neither widening appreciably or tightening. It's a fairly neutral environment. And the blue dots represent a spread widening environment, so a negative risk environment. What this chart shows is that we've been able to generate excess returns all the way back to 2012, since the beginning of Coolabah, consistently through this period. Worth noting that the median holding period, if we blend all of our primary or our new issue trading and secondary trading together, is 39 days. And we've delivered a hit rate of 94%. We've made money 94% across all of our trading. Of our 15 billion of net assets under management, or net FUM, we are delivering this excess return strategy into all of our different products, with the exception of a few. We're delivering this excess return credit alpha generating investment process into our products. But some of our products are benchmarked against, like this one, comp bond index. Some of them are absolute return, they're zero duration. So how do we combine this excess return engine, which has delivered really durable returns through cycles, through different environments? Well, FIXD, the ETF, is a good example of that. Last 12 months, it's returned 8.4% compared with the index's return of 6.8%. And since its inception in 2017, it's delivered 1.4%. And how does it do that? Well, the excess returns over and above the benchmark are coming from that implementation of that new issue and secondary market trading. And what we're doing is we're matching the duration, the interest rate duration profile of the Oz Bond Composite Index in order to match its interest rate sensitivity. So this is what we're doing in our long duration products. And we also have a global version of this product, which is benchmarked to the Bloomberg Global Ag Corporate Index. This has been very popular offshore for European investors. We've delivered similar excess returns. Since inception, this product has delivered those excess returns of 1.73% per annum. We have some absolute return funds as well, which have zero duration. So this is the same alpha generative process, but this particular product, floating rate high yield, is implemented in a very simple way. This particular one has 90% exposure to Aussie majors, so CBA, NAB, ANZ, Westpac. 100% floating rate Aussie dollar bonds, has a running yield of 7.2%, provides daily liquidity, quarterly distributions, and there's no performance fee. There are other ways you can generate 7.2% yield, but in our view, you have to take more risk to get it. We have a global version of this product, which is an ETF. YLDX is the ticker. And it has a similar overall profile. One of the main differences here is this fund pays monthly distributions compared with the floating rate high yield quarterly distributions. But again, daily liquidity. YLDX, we think, is an interesting alternative to hybrids. YLDX, the investment universe, has a higher rating, single A plus versus triple B. It has more liquidity. The underlying universe of YLDX, which is a $30 trillion universe of bonds, is much bigger than a $30 billion universe of hybrids. Last 12 months returns, and actually its returns since inception, have been very strong compared with hybrids, and also WildX has significantly lower volatility as well. While we're on the topic of diversifying sources of alpha and the durability of those excess returns, I wanted to introduce our active sovereign bond fund. This invests solely in AAA Australian Commonwealth government bonds, so there's no credit in this fund. It's generating alpha purely from relative value in Aussie AAA sovereign markets. The chart on the right shows the performance of the fund. The black bars are the peers, including Ardea, JCB, and another offshore global strategy which has been popular overseas. And this strategy has delivered 10.5% return before fees since we started implementing it in November 2022 with a Sharpe ratio of 2.4. So really, really strong, durable excess returns. Just a quick overview of the yields on the spectrum of products we have, all the way from Long Short Opportunities Fund with a 7.8% yield, all the way down to our enhanced cash short-term income, for example, with the ticker FRNS with a yield of 5%. Really strong yields across the platform. And I'd like to leave you with just a summary of the 3 key ETFs we have available. First of all, YLDX, I mentioned already, that's the global version of floating rate high yield, which has a 7.1% yield. FIXD, which is our long interest rate duration fund, currently with a 5.9% yield. FRNS, which is our short-term income fund, available in ETF, with a 5% running yield. And just finally, to leave you, this QR code is also in your programs, but we'd be very grateful if you would like any funds onboarding to new platforms. We would be very grateful for your pledges. So thank you very much.